Hi, I'm Rick Kaler. Thanks for joining me today. So, how much is a tax deduction worth? Well, it might be less than your money scripts would have you believe. Let's cover some common ways that overemphasizing deductions may actually reduce your tax bill, but end up costing you more money than you save. Let's take a look at maintaining a home mortgage. How often have I heard somebody say, I could pay off my mortgage, but then I'd lose the interest deduction? Consider this. On average, a home interest deduction is worth 12 cents for every dollar paid in interest. Now, this is say for the average American that has taxable income of under $81,000. This means the net out-of-pocket cost is actually 88 cents. If you don't have a mortgage, for every dollar you no longer spend on interest, you will now pay 12 cents more in taxes. So your tax bill goes up. But you will also have 88 cents more to keep to add to your net worth. So reducing your net worth by $1 to save 12 cents, that is not a sound money decision. Let's take a look at rejecting income to avoid going into a higher tax bracket. Now let's take a couple with a taxable income of $81,050. They're in the 12% tax bracket, but a $1 raise would put them into the 22% tax bracket. Test question, should they take the raise? The answer, of course, is absolutely. Those who had turned down the raise probably assume that their taxes would increase from 12% of $81,050, which is $9,726, to $17,831, which is 22% of $81,051. It would make perfect sense to turn down the dollar if that was the case, but fortunately, this is not the way tax brackets work. The higher bracket applies only to the earnings over $81,050. The dollar raise will be taxed at 22%, which is 22 cents. So your tax bill will be $9,726.22. That's worth it. Next, not carefully comparing traditional and Roth IRAs. Contributing retirement funds to a traditional IRA provides an immediate tax deduction, but choosing a non-deductible Roth IRA and paying some of the taxes up front could actually make more sense. Let's take the example of a young married couple with a taxable income of $19,900. They're in the 10% tax bracket, with a good chance that their income at retirement will be considerably higher, saving $10,000 or 10% in taxes. Today could mean paying 12%, 15%, or even 37% on the funds when they're withdrawn in the future. In this example, with a Roth IRA, you pay 10% taxes on your contribution today in order to never pay taxes on when the funds are withdrawn. Now, you might be thinking, wait a minute, if I'm a married couple and my taxable income is $19,900, this doesn't sound too good. Where am I going to have $6,000 or $12,000 for a couple to put into an IRA? This is taxable income. That's the real important distinction. It's not adjusted gross income. It could be that maybe they had business losses, casualty losses, who knows what's going on, to push their taxable income down to $19,900. So That's an important thing to keep in mind here. Another one is avoiding Roth conversions. So in similar fashion, it often makes financial sense to convert a portion or all of your traditional IRA to a Roth IRA. If you are in a lower tax bracket today than you expect to be in when you retire, this usually makes sense because you've got to pay taxes when you do the conversion. So you're paying lower taxes on the amount converted now instead of paying higher taxes later. Finally, the other kind of myth is holding municipal bonds. Bonds issued by municipalities are tax-free. So why pay taxes on interest from corporations and U.S. Treasury bonds when you could pay no taxes on interest from bonds used to finance local municipal ventures? Well, here's why. The current average interest rate on high-quality 10-year municipal bonds is about 1.1%. The average interest rate on high-quality 10-year corporate bonds is about 2.1%. That's a percent higher. Even if you're in the highest federal tax bracket, owning the taxable corporate bond would net you $1.32, which is still higher than the municipal bond. It's important to do the math before investing in tax-free munis. So spending $1 just to save any portion of it in taxes only reduces your net worth. Such behavior isn't in your financial interest, even though it's completely rational based on the money scripts and emotions behind it. Those beliefs might include a distrust of government, a desire to punish or control government by reducing its revenue, inaccurate assumptions as to how tax brackets work, and maybe a money script that paying less in taxes is always the best choice. Tax deductions only make sense if you actually need or want to spend money for deductible items like property taxes, interest, charitable giving, or necessary business expenses. Reducing taxes by overvaluing deductions, it only reduces your own financial well-being. Thanks for joining me.